This isn't a time to be, leveraged up to the hilt and trying to make as much money as possible. In our view, I'd say, be very, very cautious. I don't really share Jay Powell's enthusiasm for the overall economy. Inflation is something that once it gets going is sticky and it's not easy to eliminate.
Hi, and welcome to Wealthion. I'm James Conner. Well, the U.S. election is finally over and a new administration is taking over. So what does this mean for your investment portfolio, if anything? To help answer this question, have a discussion with a Wealthion endorsed financial advisor. You can find out more information at wealthion.com/free. Once again, that's wealthion.com/free. Now on to the show. Jonathan, thank you very much for joining us today. How are things in Toronto?
Yeah, things are going well, and we're just getting all the leaves off the tree. It's been a warmer fall, as you know, and so we've been enjoying that. But we're getting ready for winter, so things will get a little bit cooler soon.
So even though you're based in Toronto, much of your portfolio is comprised of U.S. equities. So much has happened in the U.S. here just in the last couple of weeks. We had a U.S. election with a resounding victory for the Republicans, not only in the White House, but also the Senate and the House. We've had another cut by the Fed, 25 basis points. We were pretty well through Q3 reporting season, and for the most part, the numbers weren't too bad. But what's your take on the U.S. economy? Do you have any concerns?
Well, the typical concerns you're going to have is that the overall indebtedness of the economy. So the deficit 6% plus of GDP in a time where you actually have economic growth. So this is a big concern. This has been a concern, of course, for quite some time, and so that would be the major concern, just the overall deficit that they're running and the accumulated debt. 35, $36 trillion is a huge number. Now, I'm very much thrilled that Donald Trump was elected vis-a-vis another 4 years of the Democratic regime, which I don't think would have been good for the capital markets. They were talking some of the policies that Kamala Harris was talking about, increasing taxation. In fact, even talking about taxing unrealized capital gains. That would have been just a nightmare if something like that would ever been put in place. So I'm certainly happy that they're going to have a government that's more geared to growth, less regulation, lower energy costs, because they're going to try to open up more drilling and so forth. So I think those are going to be positives, and clearly the market has responded post-election with a little bit more enthusiasm in terms of a much more growth-oriented agenda back in the United States. Having said that, it's going to be, Trump's going to have to be careful. They have a large budget deficit. If he does want to continue to cut taxes, that could cause, again, more problems from a fiscal perspective. So we'll have to see how things emerge. But there's some good people there. There's some good ideas. And I think that's going to put a little bit more pressure on other countries like Canada. It'd be a little harder for Trudeau to continue zapping us with more taxes when our neighbors south of the border are getting tax relief.
Yes, raising taxes is never a good idea for a politician's career.
Well, and of course, as we've talked about before on previous shows, the government already controls almost 50% of the GDP in terms of the total level of spending at all three levels of government. That's just excessive. We cannot continue to grow government. And so we're going to have to take a hacksaw to the government in this country and also the United States. It's interesting that Elon Musk is talking about taking $2 trillion out of about a $6 trillion budget. Now, I think that might be a little bit aggressive, but it would be a wonderful thing if we had some top people actually look at the bureaucracy and the bloated nature of government and start to shrink it once and for all. But we'll see if that happens. I think that's probably being a little optimistic. But if that were to happen, that would be awesome. That would be absolutely awesome.
Now, you mentioned that the deficit is running at 6% of GDP. Can you put that into perspective? Is that a record number, or how does it compare to the past?
Yeah, right now it's running vis-a-vis the past, probably at the high end of anything that we've seen in the past, particularly when the economy is still expanding and growing. Okay, so typically when the economy is growing, expanding, you really don't want it growing any more than you don't want a deficit larger than the actual economic growth, so that your debt to GDP ratios are not expanding. But when you have a 6% debt to GDP deficit, each year, and your economy is growing at say 2 to 3%, that means your overall debt to GDP is growing much more quickly, and this is just not sustainable. So yeah, occasionally you might get up to 6% in a recession, financial crisis, things like that. But we've just become used to running these massive deficits all the time now, and that just cannot continue now that the debt levels are so high. Yeah, very concerning to say the least.
So the other big news recently was the Fed, and they cut by another 25 basis points after cutting 50 in September. And Jay Powell said the economy is in great shape, inflation pressures have eased. But I have to be honest, I take issue with anybody who says inflation is under control, because I don't think it is. And we recently saw some economic data out of the US. Unit labor cost increased by 1.9% versus expectations of 1.1%. Labor productivity was 2.2% versus expectations of 2.6%. So costs are going up, labor productivity is going down. It's the same thing that's happening here in Canada, and it's been going on for quite some time. And then when you look at the number of unions that have negotiated some very excessive pay raises, the longshoremen on the West Coast, they got a 32% pay increase. East Coast longshoremen got 60%. But what are your thoughts on what Jay Powell said about inflation and any other comments he said about the economy?
Yeah, I mean, I'm skeptical. I mean, I hope he's accurate, but we certainly are not betting on it or investing based upon what Jay Powell is saying. I mean, we're being very careful. I think what you've pointed out, you've got these labor costs going up, unit costs. What we need to do, and hopefully, again, a new administration in the United States will help this. We must free up the private sector to be able to make more things, produce more things, to be more efficient. Again, productivity has to continue to increase. In the United States right now, under the Biden-Harris regime, I mean, private sector jobs are practically non-existent. I mean, they're very weak. It's been the government jobs that have been growing. Same thing here in Canada. And so I'd argue that the economy is weaker than what Jay Powell is suggesting. Certainly much weaker in Canada, but even in the United States, I mean, you've got housing prices that have come down. You've got weakness in the job market. People's discretionary income is low. They've been borrowing more money on the credit cards and so forth. So these are all indications of an economy that's under some stress. And of course, that's why I think Powell dropped the rates another 25 basis points. But I think he's maybe not being 100% honest in terms of some of the challenges underneath the surface. But well, I mean, some of this might be helped by a better government that starts to cut regulations and get costs down. But that again will take a number. That's obviously going to take a number of months. That's not going to happen overnight. And so, no, I don't really share Jay Powell's enthusiasm for the overall economy.
And some of the policies that the Trump administration wants to put forth, such as deregulation and also tariffs, these policies can become inflationary. Do you think, as we enter 2025, that there's a threat that inflation heats up again, and maybe the Fed is not able to cut interest rates? They're going to have to pause or maybe even increase interest rates later in 2025.
Yeah, I mean, we'll have to see. I think that is a risk. There's no question that is a risk. I'm not sure that that will actually take place as much as people talk about it. They talk about for example, the Trump tariffs. I mean, he uses that as a weapon, as a massive stick. I mean, what he's trying to do is get the ability for Americans to be able to sell into other countries around the world much easier. And so he's going to then make it harder to go into your country. So he's using that as a big stick. I mean, when he was in his first term in office, 4 years, yeah, he put the tariffs up, but those were selected. They didn't really cause an inflation issues. And so I think you have to discern between Donald Trump sort of rhetoric and the bravado that he uses, and then how he would actually implement that. I mean, he's out there to scare people, other countries, into opening up their markets so that the U.S. can also do more business. So I think a lot of what Trump is going to do ultimately should lead to lower inflation, not increased inflation. I don't buy the fact that. I mean, clearly, if he was just going to double and triple tariffs or put them up 100% or 200%, like he talks about, well, of course that would put prices up. But I just don't think that's going to happen. He's using that as negotiation tactics. He loves to do that, and I think he's very effective at it. So I would love to have him running our economy right now in Canada and change things up here and get things moving. But we'll see. We've got hopefully Pierre Poilievre in the wings.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family.
So Stanley Druckenmiller recently did an interview. If you haven't seen it, I would suggest everybody check it out. It was a great interview, lots of interesting insights. Anyhow, he thinks one of the biggest threats to 2000, or one of the biggest threats we'll see in 2025 is a reacceleration of inflation. And he actually said this time that we're living through right now, he compared it to the early 1970s, where inflation took off. I think it got up to 8%, then they were able to pull it back. It got down to 3%, and then it just reignited again, and it went into double digits. And he said there's a threat of that happening in 2025. Any comments on that? Did you see that interview by chance?
I didn't see the interview, but Stan Druckenmiller, as you've pointed out, is exceptional. He's a great thinker, and he's certainly worth listening to. So I'll absolutely listen to that. Yeah, I mean, look, it's all, see, the inflation, or whether it's high or lower, it's going to be a lot of policy. It's going to be policy driven, and that's why it's difficult. So I think if you're taking Stan Druckenmiller's position, if you've got governments continue doing what they're doing, expanding and making it more difficult and pushing green agendas and making energy more expensive and spending more money and so forth, then I think that's all inflationary. But I guess the issue will be, is that what's going to actually happen in 2025? We'll see. Our view, when it comes back to investing, is trying to find businesses that can push on their costs and are a little bit more of an inflation hedge and can protect our investors as best as possible. Because I'm not sure exactly how it's all going to pan out. We'll have to see. I mean, when you look around the world, you look at Europe, it's really low growth, and you've got incredibly mismanaged governments over there. Whether Germany, France, now you've got Britain, you've got a socialist government there. It's a nightmare. If you look at Japan, again, you've got very little growth out of Japan. China, as you know, has just started to put more stimulus in there, and they're trying to protect themselves again from maybe a more aggressive U.S. policy. And so when you look around the world, there's not a lot of growth and a lot of activity going on. So again, we're just trying to be cautious, careful, making sure that our investments will respond well and be able to continue growing and adding value to our shareholders, our investors.
Well, I think his concern is that, especially when you get these unions that are negotiating these massive pay increases, all these higher prices are going to trickle down to the consumer. Okay, mm-hmm. Me and you, everything we buy, the price is going to go up. So even though the Fed says we got inflation under control, we got it down to 3% or whatever their number is, all these unions are negotiating these much higher prices, and that's going to trickle down. We're not going to see that probably until sometime in 2025.
There's no question we'll have to keep our eyes on that. I don't deny that at all, but we'll have to see how that filters through. And businesses are pretty productive, and they come up with other ways to help cut costs and so forth. So we'll have to just see how that pans out. From our perspective, when we look at our fixed income investments, for example, we're still staying short, or maybe out 2-3 years. That's it. We're very careful in case, again, inflation does pick up. I'm not going to take the risk of bond yields backing up further. I'm not making a big bet there because, again, as I said before, it's difficult to know exactly how it's going to pan out. You can listen to smart people, brilliant people on both ends of it, talking about deflation and inflation. And, it's a tug of war. And from an investment perspective, when we're looking after people's money, we try to find a good balance in between, and then businesses that won't be too disturbed by either. At least they'll be able to protect us as much as possible, because it's a bit of a wild card there, again, based upon policies and how things emerge. Definitely, though, inflation is something that once it gets going is sticky, and it's not easy to eliminate. And so I think Druckenmiller's points are well taken. I was in high school back in the 70s, the late 70s. That's when I was in high school. And I remember the inflation and the auto companies every 6 months putting their prices up, and it got embedded in all the contracts, all the labor negotiations at the time. And it was brutal to get rid of and to stop. It was very difficult once it starts growing. So I think we do have to be attuned to that. But if we can get energy costs down, and we can get people off this, this forced green agenda. Not that we don't want to be renewable and green, that's fine, but on a reasonable time frame that technology and industry can absorb properly. I think we can maybe get some of these costs down that we've been foisting upon ourselves because of sort of more left wing woke agendas.
Yes, it would be nice to see the price of oil crack and head down to $60 or lower. And it's been hanging in a very tight range all year, somewhere between 70 to $80 a barrel. Right now, it's around $70 a barrel. So, um, any thoughts on energy and oil and where you think it might be going in the next year?
Yeah, I mean, certainly the oil and gas sector is critically important, absolutely unbelievably important, and it will be for the next 100 years. I mean, this idea that we're going to get off fossil fuels is crazy. Having said that, I think that Trump coming in will put the pressure on oil. So I think the prices could drop, and that's because he's going to, open up as much as possible. And I think the Saudis and other people around the world are going to have to compete with that, and they don't want the Americans to take over the market as fast as they did last time. It's only 4 or 5 years ago, and the Americans were basically the swing producer. So it was amazing how they developed that industry. So I would be one that I'd be careful. We do have some oil exposure. We've got some great oil companies here in Canada. We're trying to buy ones that are very profitable at $60 a barrel. But I could see the price of oil, yeah, definitely coming down a little bit. And that would also give us a little bit of coverage in terms of inflation pressures and certainly help out in terms of businesses and industries. That could be very good for the mining industries, where, as the water costs and energy costs are, 30% more of the cost structure. And so that I think is going to be a net positive.
So you touched on interest rates and bond yields earlier, and the 10-year has ripped from 360 up to 440 in a relatively short period of time. What are your thoughts on that, and why do you think we've seen the yield increase the way it has in the last couple of weeks?
Well, I think, there's probably a couple of reasons. And one reason why we'd be careful about going out the yield curve, and that is just these massive deficits. And I mean, they're huge all around the world. It's not just the US, you've got a lot of deficits. And those have to ultimately be, not only are you paying for the deficits, but you also have a lot of debt that's coming due because, if you take the American situation, a lot of their debt is very short term. So you have trillions and trillions of dollars rolling over constantly. If the Fed's not going to pick it up, it's got to go into the market. And the market's looking at this and saying, hey, wait a second, we're not going to absorb this unless we're going to get paid more for it. So I think that's the concern. And with Trump, certainly in the early days, it could lead to larger deficits depending on tax changes and so forth. I think there's some concern that could cause again a blowing out of the yields. So yeah, I think that's what's getting embedded in the yield curve. And yeah, I mean, who's going to buy all this stuff? Who's going to absorb all this debt that we've created over the last 20, 30 years? It's insane, the level of debt that's out there. So, and then if the Fed steps in and starts buying it, then we're just printing money, we're depreciating our currency, and we're back to inflation again. So, we're in this bit of a tug of war here, and it's going to be quite interesting to see how it all emerges. It's not going to be it's not going to be easy. Let's put it that way.
So you're a big follower of Warren Buffett and his investment style, and he's been raising cash. We've discussed
Yeah.
this before, but he sold another 100 million shares of Apple, which is a massive number. But he's sitting on $325 billion worth of cash now. What are your thoughts on this? And do you see this as a warning sign of what might be coming?
Yeah, as we've talked about over the last little while, I think anybody who doesn't take Warren Buffett seriously and process what he's doing, I think is very foolish in short term. I mean, Buffett is a financial genius. I mean, he's proven that over 50 plus years. Well, actually 60 plus years. He's 94. So there's no question that he is raising cash in order to be more nimble, probably opportunistic, and to protect some of the value that he's created in Berkshire Hathaway. And so he's talked about this concerns over valuations in the market. And as we've talked also, I mean, valuations. I mean, you have to be careful because you can always find a company that's more attractively valued than others. But overall, I mean, everybody knows that the S&P is trading in 20 plus times earnings, and that is at the high range of multiples. We all know that the economy is getting a bit weaker and things like that. So there's a lot of debt and concerns over that. So it tells you that one should be careful. That's why in our own portfolios we're carrying we carry about 30% or so cash or near cash, short-term interest-bearing investments. and the securities that we're buying are pretty conservative, and we're being very careful in terms of that. So I think, yeah, Warren Buffett is a good signal of what's taking place in the marketplace. And I think a good rational approach. Be careful. This isn't a time to be leveraged up to the hilt and trying to make as much money as possible. In our view, I'd say be very, very cautious. There's lots of changes that are going to be taking place over the next number of months and year.
And why don't we do a deeper dive on you and your firm, Rocklinc, and maybe you can tell us a little bit more about your investment approach and your style and how many companies you currently own in a typical portfolio.
Sure. I mean, we're what you typically would call a value investor. I mean, I wouldn't say it's a deep discount value investor. That's otherwise we'd hardly have any investments defined. But when we talk about value investing, we're trying to value companies based upon we typically look at free cash flow and do a present value analysis of the free cash flow using discount rates and so forth. There's some businesses we're going to look at an asset value because of the nature of their business, net asset value. And so what we want to do is have 20 to 25 companies that are well researched, that cut across generally 5 to 6 industries. So we don't want to be overly concentrated in just one industry. You have to be careful of that. And find a handful of companies that are run by really good people, smart people. The business model makes a lot of sense. And we can value them and say, you know what, these things are trading at either fantastic values or pretty decent values. And our investors can make some money over the long term. And so we keep it simple and really understand the companies well. And so that's why we sort of call it a Warren Buffett approach to investing. We're not interested in the index. We don't follow the index. I mean, other than, it is a benchmark we want to be beating. And we're not sort of just ETFs where we're just buying, a whole bunch of companies all in one sector and stuff like that. To us, that's one way of doing it, and that's no problem. I mean, there are investors that do it, approach it that way. That's fine. We love the game of investing and researching and talking to companies, getting to know the businesses, building models. We think that's a fantastic way to do it, and that's just what we like doing. We're really research oriented. I got several guys here that are CFAs, and that's what they love, doing spreadsheets and talking to all the companies. Right now, it's been busy because we have the third quarter results coming in, so we're on the horn with all the companies, listening to the reports and getting the information as it comes in. And it's been a pretty good quarter. Although I think one observation I'd make is that organic growth is slowing down in some of the businesses that we own. And we look for companies with strong organic growth. That's one of the things that obviously you want in a company if you can find it. But it is definitely harder to come by in more and more of the businesses, just because of the economy being a little bit slower, and just they're having to work a little harder. But a lot of the growth we've seen over the last couple of quarters has been price increases. But again, that's going back to your inflation issue. But that's not really sustainable. If the only way you're going to grow your business is putting your prices up.
Yeah, everywhere you go, it's price gouging. Prices are never going to come down. They're going to stay where they are. They're going to go higher. And so you made mention of the fact that you own 20 to 25 names in a portfolio. How many of those names would be U.S. versus Canadian?
I'd say about 30, 35, 40% might be Canadian-based companies, and then the rest would be US-based companies, and then we will have a few European-based companies. But when I say it's important to emphasize. So when I say Canadian-based companies, those are generally, I mean, you talk about Brookfield, for example. Well, that's a global business. So we really only own one or two companies that might be 100% Canadian and just operate in the Canadian marketplace. So we are trying to buy companies. One of the things when we're looking at businesses, I think it's an advantage if they operate in a number of jurisdictions, and they give you a bit more protection of currency, protection, diversity of economies, things like that. So that's an advantage if you have a company that's operating in a number of jurisdictions.
And one of the reasons why Canadian investors have to go to the U.S. is because of growth. And let's just say technology, for example, that's a massive growth engine in the U.S. And those stocks have done extremely well here in the last 5 or 10 years. And we don't have that in Canada. But what advice would you give a Canadian investor on investing? Because if you're buying a Canadian ETF, like on the TSX, you're not doing that well, especially when you take into inflation.
Yes, I mean the problem with the TSX. I mean, again, we're blessed with fantastic companies here in Canada. There's no question about that. But it's a bit more commodity oriented, as you know. And commodities aren't necessarily naturally compounding companies over time. They'll go up, but they're cyclical, so they'll do very well and then they'll back down again and things like that. So the Canadian economy doesn't have the breadth and diversity of the U.S. economy into into consumer staples and technology companies, a broader base of financial businesses, infrastructure. I mean, there's a whole host of areas where we just more limited, but particularly we're heavily weighted in banks and then energy in some of the resource sectors. And so I think that I would not be buying the Canadian index at all. I mean, I just don't think if you're going to buy an index, probably the S&P 500 or something like that is a much broader index and gives you good global exposure. The TSX just wouldn't give you that. I'd be much more selective in buying certain businesses or targeting certain industries. Even if you weren't buying individual companies, then I would be more interested in picking a few ETFs in some sectors in Canada that might be more attractive, rather than buying the overall index in Canada, which it just isn't the best index to be trying to create wealth off of.
And where are you allocating capital now? I know every client is different depending on age and risk tolerance, but maybe you can give us some sectors where you're investing or some specific names.
Yeah, okay. In terms of, we think some of the names, some of the, as we're looking at the results that are coming in, some of the infrastructure companies. So we're just looking at the results from Brookfield Infrastructure, and very attractive company, 5.5% dividend yield, trading at a nice multiple, great growth opportunities. So they've got some really interesting opportunities for growth, including their parent company, also Brookfield Corporation, which we think is undervalued, and trading at very attractive prices. We've also continued to invest in. We just had the results yesterday for Burford Capital, and they again are litigation finance, and it's doing very well. Things are going very well in that business. They're really generating a lot of cash. We think that's undervalued, and they also have an opportunity for some large litigation solutions that are coming through. Especially in Argentina, they've got a big one outstanding there. But that's a neat business that'll continue to move along, and it's also trading at very attractive prices. In the technology, we're always trying to look at the technology space because that is a large long-term growth area, and so software companies, in particular, are great places to be. We've got positions in Autodesk, which is just an incredible business in terms of CAD and be used for engineers and anyone that's doing construction. Also Roper Technologies, and we have added. I mean, it's just jumped more recently, but over the last number of months, it's going back a little bit. We will pick away a little bit on Amazon. We think of all of the big guys. We still like Amazon, and it doesn't trade at a ridiculous multiple. And they continue to grow their business and do amazing things with their AWS and also their cloud business and also their retail business. So yeah, there's some areas. So infrastructure, financial, technology, just hammering through name after name. A lot of our companies, so it's very name specific, business specific, in terms of where we invest, and just to continue to ferret out opportunities.
And the last time we spoke, you had an allocation toward some gold names. Do you still have an allocation toward gold?
Absolutely, yeah, absolutely. I mean, the precious metals. We continue to own. That I would say that's our second largest sector exposure. So it would be a significant exposure, which is unusual for a lot of money managers. But as we've talked about before, we typically, the majority of that would be invested in royalty companies. So basically the investment bankers to the mining businesses. We have a big position in Agnico Eagle. Fortunately, it's turned out, I mean, Sean Boyd's been an amazing executive for many, many years. And that's why we targeted Agnico Eagle a number of years ago. And we're so happy that we did, because the execution has been just amazing execution. His margins are up. We were just looking at his, their latest release from Agnico Eagle. His costs are up like 1.7%. Can you imagine? With the price of gold up 30%. And so his margins have just, they're up, his net margins up over 70%. It's just phenomenal in terms of the way they're running that business. And so, yeah, Agnico Eagle, and then we own the royalty companies. So we do own, we do have some Franco-Nevada, and have added to that when they had, especially the challenges with the copper mine back in the Cobre mine in Panama. So Franco-Nevada is great. Wheaton Precious Metals is another, beautiful one. Cisco Royalties also. So we think that's a very important space, because when we talk, as we talked about already in this conversation about inflation and deficits and government policies and all that's going on in the world, we love to have some gold and a little bit of silver too, because it is a hedge, and especially if we can buy companies that can generate lots of cash and cash flow from gold and silver, in which the royalty companies do. So that's an area that we have no interest in moving from for the foreseeable future, especially given what we're seeing in the world. And if Trump does get aggressive and run up more deficits and try to cut taxes and so forth, then that's even more of a reason to own some more gold. And if there is inflation, absolutely. So
And one of the other big benefits for Agnico is 75% of the production is in Canada, a country that respects the rule of law, unlike many other countries out there. And then, of course, a lot of their expenses are in Canadian dollars, and that really helps also.
absolutely, absolutely, no question. When we're looking at the companies, the political exposure and geographic exposure and political risk is absolutely important, essential, especially if you're just buying a miner that has a handful of mines. One of the benefits of buying the royalty companies is that they, in many cases, they might have 200-300 different royalties operating across many, many countries. So if there is a problem, even we saw a big one with Franco, which is one of the best of all the royalty companies. Yeah, it took it down about 20-25%, which is not what you want. But then it's generally working its way back up over time. Whereas if you had a mining company like First Quantum, they lose 60% of their value, and they're basically cooked, right, for some time. And you can take a massive, massive hit, and it might take years to come back, or it might never come back. And so again, when you're buying miners, I mean, we're finance guys. We're not geologists. You have to really, really do your due diligence. And I think from our perspective, we could really never go up the learning curve enough to be out sticking our head in holes in the ground and trying to make mining, picking junior mining companies. That's where we would look to more experts, or at least diversify more and pick up more names, because I think that's just very difficult thing to do over time.
So we had a good conversation about the U.S. economy, and the people have spoken. They were not happy. And let's talk about the Canadian economy now. What are your views on the Canadian economy?
Well, we're weak, weak, weak. I mean, our governance in this country is not unlike the Biden-Harris regime, although the U.S. economy has been more resilient and pushed back against a lot of the policies that they were executing on. In Canada, I mean, we've got just regulation after regulation, tax increases on tax increases. We have a government that's sticking its nose into all of areas of the private sector and so forth. And so we have money leaving the country. I mean, our greatest resource is our commodity sector, and the federal government, that is, has made it very difficult for long-term capital projects. And so we've had so much money leaving the country. I mean, I was just reading an article, I think it was this morning or last night, on TransCanada or TC Energy, and they're now building a pipeline down in, I think it's Texas or something. They're going to pull almost $1 billion, anyway, hundreds of millions of dollars they're putting into some projects down there instead of Canada. Why? Because it can't get anything done in this country. And so so Canada is really feeling the pressure. Our GDP per capita, as we've talked about before, is falling. I mean, it's been falling for some time, and the overall wealth levels of Canadians has never been lower when you compare it to our counterparts in the United States. So yeah, it's a difficult situation here in Canada. Our unemployment rate is 6.5%. Now we've had very little job growth. We just had those numbers, I think it was this morning, and you're talking 12, 14,000 jobs, and again, a lot of those are not in the best sectors. So yeah, we're feeling the pressure, but I think it's all self-induced by very poor management of our economy, particularly by the federal government. If we could get a change in that, I think we could unleash a lot of the resources and the assets that we have in this country. It's such a rich, rich country, but it's been grossly mismanaged for the last 9 years.
Yeah, it's quite hard to believe what's happened. I truly believe we live in one of the greatest countries in the world, but I
Yep.
really don't know what the hell has happened here in the last 5+ years. And in spite of the fact the U.S. economy has been doing so well, the Canadian economy has been struggling now for quite a few years. Labor productivity has been in decline for 10 years.
Yep.
And I don't know what it's going to take to turn it around, but it's going to take an awful lot. What are your thoughts? What do you think happened?
Well, I mean, I think it's socialism. I mean, you basically have a Trudeau government that took over, and they have executed nothing but socialistic policies right straight through all the economy, and they've made it very difficult with increased regulations and taxation every time you turn around. And so, yeah, I mean, government's just too large, too intrusive, and it needs to step back and it needs to let the free market take over. Yeah, you have to regulate the free market and you have laws, but you can't be doing all of that work. I mean, think of the projects that have left this country because of Trudeau's policies. I mean, people are not going to make 5, 10-year, 20-year capital investments if you're not feel comfortable with the government's policies. And so we must change those policies. And I mean, there's other things also. We've had the curtailment of our free speech in this country, and I mean, the government has passed legislation to limit our ability to even get information and to post it online. I mean, it's just on every level the government's just overstepped. And so you can't expect growth in that environment. But look, we are getting some pockets of pushback. You've got the Saskatchewan government. Mo was reelected, which is great. You got Danielle Smith in Alberta pushing back against a lot of these things, and you have Canadians fed up with the policies of the federal government. So I think if we go to another election, I think it does give an opportunity for Pierre Poilievre, who's articulating some amazing policies. A lot of them are just more freedom to the private sector and stepping back, cutting bureaucracy, cutting these layers of government, and that would have a dramatic impact on this country. But we'll just hope and pray that those actually take place.
And you're right about government overreach. There was no greater example of that than in January of 2022 with the truckers, and what happened there was just, I still can't believe it happened.
Absolutely, and it's going to be interesting, the conversations between Trudeau and Trump now, because Donald Trump has really spoke out loudly against the just the stepping on the of the convoy and the truckers, and those were peaceful protests, very peaceful protests, opposing government overreach in terms of vaccines and medical policies. And to respond the way they did to our own Canadian citizens was outrageous. And it's that kind of behavior, again, that runs money out of the country. And so if we can get a change in policy, I think, again, we can get money coming back into Canada, greater projects, unleashing the resources we have in this country, which are just massive. And things could change quite quickly. But we'll see what happens.
And just a reminder for our American viewers, during that time period, a lot of those protesters who, once again, were protesting peacefully, lost their businesses, they lost their bank accounts, everything was frozen. And this is something you would expect in Russia or China, not in Canada. So
yeah, that's exactly the case. And I think, we're in the securities market. We had correspondence from the Securities Commission basically targeting, I think at the time was 15 or 20 of the leaders of the trucker convoy. We actually got notifications from the Securities Commission via the RCMP, and we didn't have any clients that were, our clients weren't on that 20-person list. But basically, you had a government going after their own citizens just for leading a convoy. And just to see that and to read those kind of reports coming from the RCMP and also from our Canadian capital markets, where the government was obviously putting pressure on them, it was very disturbing, very concerning. And you see that the government is going to target, these are little people, they're average people, they're just blue collar workers, they're just fighting for freedom, trying to get their voice heard into a government that doesn't care about them. And yeah, it's very disheartening to see that. And so we really do need to change of policy. I mean, again, you look at the U.S. and you see the situation down there. And I think this is one reason why Trump won with quite a convincing margin. And that is, people are concerned about government overreach everywhere. And the Democratic Party is not unlike the Liberal Party here in Canada. They think they need to be micromanaging everything, including who can go into which washrooms and gender things, and it just extends into every area, and it's just ridiculous. And we need to change.
elitism does not work, and it doesn't matter how many celebrities you have behind you. Nobody cares. All people are trying to do is just put a roof over their head and food on the table.
That's exactly right. And as we all know, the celebrities don't live in the same world as the majority of people, and they don't face the same challenges. And so if you're in government or you're in business, you want to be able to identify with real people, the people that are actually making the economy work. and not celebrities who don't have a clue what's really going on.
Well, Jonathan, that was a great discussion, and I always enjoy our chats. And if someone would like to learn more about you and your firm Rocklinc, where can they go?
Yeah, our website is a great place to start, which is rocklinc.com. Rocklinc with a C at the end. So ROCKLINC, rocklinc.com. And you can also email us info@rocklinc.com. And you can, once you go there, you can get our numbers and all our details. That's probably the best place to go. Yeah, we're more than glad to talk with people. We've got a lot of people come in from Wealthion, we have different people that have come through this channel. And also people that just come in to have us just review their numbers, look at their statements, give them some ideas how they can improve it. That's fine. It's all free of charge. We love to talk to people. That's the business that we're in. So by all means, pick up the phone or send us an email, and we'll reach back right away and talk to you.
Well, once again, thank you, Jonathan, and I look forward to our next chat.
Terrific. Thank you very much, Jimmy.
Well, I hope you enjoyed that discussion with Jonathan Wellum. And as a reminder, Rocklinc is a Wealthion endorsed financial advisor for Canadian investors. And if you need help preparing for your financial future, consider having a discussion with Jonathan or another member of his team. You can find out more information at wealthion.com/free. Once again, that's wealthion.com/free. If you like this content, please subscribe, like, and also leave a comment. And if you want to check out more content, check out this video now.